Welcome to the Big Mike Fun Podcast, where you learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in. Because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fun Podcast. I'm the Big Mike Zlotnik, and today it is my pleasure and a privilege to welcome Nick Legamaro. Did I pronounce your name correctly?
You got it right, man. You do it better than I do. I'm not going to try to pronounce your name sometimes either.
I got to double check sometimes. I mispronounce.
Oh man, I got to double check too. Are you kidding me? All good.
So thank you for joining. Nick is an expert. He's the notes guy, right? Nick is known as a notes guy. So he's been doing notes forever. And he's been investing in real estate since 2001. And he's experienced the crash of 2008. He's obviously lived through the ups and downs. And he's bought, fixed, rented, sold, flipped, and been a lender on over 1,000 properties. Wow, that's awesome.
Just shows you how old I am, Mike, you know.
How wise you are, right?
How old I am. Maybe not as wise, but that's fine. Thank you.
But tell us a little bit about you, where you live, as I like to call it, family, kids, pets, cats, and other.
Exactly. Well, I'm in Texas. I've been in Texas since early 1990s, from Arizona originally. And I started my real estate career in right around 2000, primarily in the Dallas-Fort Worth market. But we did a lot of transactions all through the state of Texas. I lived in Dallas, in the Dallas area, all the way up until about August of 2020. And then we end up moving from Dallas to a town a little bit outside of Austin, about 30 minutes outside of Austin, out on Lake Travis. So I'm down in the Austin Hill Country now.
That's great. Yeah, I love Texas. Texas is an awesome state. And if you're in Dallas, I'm sure you know Eddie Speed. And
I know Eddie very well. I know pretty much everybody in the Dallas market. Yeah, I know Eddie and Martha, great people. I didn't get to do their summer summit this year, but I was traveling. But always good to hear his name, and always like chatting the business with him, because he has forgotten more than I will ever probably know, Mike, to be quite honest with you.
Oh, Eddie is awesome. He's a good friend of many years, and he's I've had him on a podcast, and him and Martha have come to New York, and I've hosted them here in New York City.
Nice.
At the Russian Tea Room years ago, but kind of time flies. Let's talk about you. So you live in Dallas, family?
Yeah. So, well, we just moved to Austin area.
Austin, I'm sorry.
I still say Dallas all the time. You know, after you've lived there for so long, you go, yeah, I live in Dallas, and I don't live in Dallas, and I haven't lived in Dallas for 6 months. So who knows how long it's going to take me to remember where I live. But I have two kids. They're both in college right now. They just finished. My daughter just graduated, or is graduating, from the University of Texas. And she's going to be heading now to USC for graduate school out in Los Angeles. And my son just finished his first year at Arizona State University in Phoenix, or in the Phoenix suburbs. And now they're both just sort of taking a little time off for the summer. We'll see what happens.
That's great. Yeah, family is the most important thing.
Absolutely.
All right, so let's talk a little bit about notes. So what do you see? Let's just start this way. What has changed during COVID? What have you seen transformational in the notes business?
Well, so that's a great question. And I think what's happening now on the note side, as well as on real estate, it's a crazy market out there. And I don't know anybody ever predicted it. I really didn't think there'd be a real setback per se. I didn't think it would be as gangbusters as it has been for the last better part of almost a year now, probably since about June or July of 2020. I mean, there was about a 30 to 45 day where people were going, whoa, what just hit us? But notes are extremely popular and valuable right now because, well, a couple of reasons. One, as you know, mortgage notes are secured by the physical property, the asset, whether it be a business or a home or whatever. Well, if properties continue to go up in value and you own the mortgage note, your risk is mitigated every time that value goes up in value. So notes have become more popular, especially in non-performing notes. Performing notes will always be popular just because they're more passive in nature and people like them. But where I think the true opportunity is coming, let's talk about what's happened over the last 10 years, right? Since the correction of 2008, 9, whatever date you want to throw in there, mortgages and traditional mortgages that have been written by Chase, Fargo, Bank of America, they've all been extremely low interest rates. We're still seeing low interest rates on mortgage notes. Well, as corrections start to happen and the market starts shifting from a seller market back to a buyer's market, and this forbearance period, that's what we've seen the most, happen in the last year is all the forbearance of mortgages that have been sort of kicked down the road, for lack of a better word. And that's all coming to a head really, really soon. And where I see the opportunity is I am big into creating notes, not necessarily buying and selling them, but I have bought many, many notes. I've sold many notes. I fixed many notes. But my true desire is to create notes out of something that either exists today in the form of maybe underlying debt, and we can talk about that, or just by going out and creating my own opportunity and creating deal structure. So where I see the big opportunity, Mike, coming in the next 12 to 18 months is there's so much cheap debt out there. And what I mean by that is all these mortgages that have been written for the last 10 years are all at somewhere between 2 and call it 4.5%, 5%. That's cheap capital. And if you can buy the rights to that capital because you're able to buy it on a either subject to or some other creative financing mechanism, you can turn around and take that and reuse that debt and then basically wrap it with more expensive debt and then basically arbitrage the difference. And that's how we profit on these deals. And that's a win-win for everybody, because a seller, this is what happened. This is what used to go on before 1990. All these mortgages were written this way, and you'd buy the rights of somebody's mortgage. Now, these are not assumable mortgages, and the bank will tell you that you can't separate the deed from the note. And they say they may call the note, but at the end of the day, doesn't mean that you can't do it. And if they decide they want to go and try to do something about it, well, there's many, many exits around solving that problem if in fact it comes to pass.
Well, that's a lot of information packed in this this short paragraph, but I love it. So let's just continue this conversation along the lines. So you see the opportunity today in buying houses subject to the existing debt, whatever it is. It's great, cheap, low rate, 30 or whatever, 15-year mortgages, and then wrapping them around and selling it to sort of seller financing to the buyers who can't get the debt, and they wind up paying higher rates and creating arbitrage. Where do you see these type of deals? You see them in the Texas area? You see them other states?
Oh, they're everywhere. I mean, I think the last number, I don't trust all the numbers that I obviously read and see because what you don't really know is really what drives it. But let's just say there's 4 million loans that are in forbearance. That's sort of the number, and that's really just talking about the mortgages that are the federally insured stuff, right? The Freddie, Fannie, things along those lines. There's a lot of mortgages that are out there where people are in forbearance that are privately held mortgages. For example, what people don't realize, Mike, is that the number what I will say, the mortgages that are written each year that are non-traditional bank mortgages that are not written by Chase, Wells Fargo, Bank of America, Citi, all those big banks, that the ones that are writing these deals, it's about a $25 billion a year industry. That's a pretty big number. 25 billion, that's billion with a B, meaning that in the last 4 years, basically, there's been over $100 billion in what I would call privately created seller finance paper that's been written that doesn't have the name of Chase or Wells Fargo on it. And so it's the market is there. The appetite's there. The need is there. And as we continue to grow as a country, and the amount of entrepreneurs that are out there and self-employed and 1099 folks that are out there that have to create and start their own businesses, there's just a desperate need for having other alternative financing mechanisms besides Chase and Wells Fargo and the big banks.
Yeah, that makes a lot of sense. So these opportunities do exist. I'm well aware of it, and I know people who originate these I guess they're conforming, but they're non-Chase, non-Wells Fargo, and other loans, and they can have a high interest rate, although they have a hard cap due to Dodd-Frank and some other.
Sure.
But let's continue the discussion. So for investors, how do they invest? I mean, in these, the question is, where's the opportunity? You as the specialist, and I know Eddie's Speed and other guys, and many of, I call them his disciples and students, know the business, right? If you're active in the business, you have a marketing machine to get the deals. If you get the deals, essentially what it means, you're able to buy a property, maybe at a discount, maybe the discount is in the terms, right? You buy the property because it's got a great debt, and you just wrap it around to somebody else who wants to, there's certainly an opportunity to get a great property acquired, cheap debt, you sell and seller financing, you create arbitrage. But for passive investors, how do they get into these type of deals? Can they get into these type of deals?
Well, sure, because they can be so I'll start with the last part first, and then we'll go back to how we sort of create this. So, yeah, so they can absolutely participate in the investment side of it, depending on whatever that might look like. And there's different ways you can do that. There's brokers out there. We can help place capital if need be, because we're really providing them the note, right? So we're not like doing some type of fund. At least we're not doing it right now. We'll just provide them to be a lien holder on the note.
Passive investor.
And just be buying. So instead of buying the note directly from something that's been created 3 or 4 or 5 years ago, we're going to create the note, and then you can just materially participate in the ownership of it. So let me give you an example of one like we're literally just doing. This is one down in San Antonio, and we look at them all over the United States, and they come in from a lot of different sources and partners that come in. So this one is down in San Antonio, and the underlying debt on it, it's the property's worth about $150,000. It's just your typical middle America, blue collar neighborhood where, we're going to find a hardworking, deserving family that wants to have home ownership when Chase has told them no. So the underlying debt on the deal is about $64,000 at 5% interest. And I go, first I saw it, that's not that great, really. But I dug a little deeper. Well, this note was written in 2006. So once you understand what amortization looks like, and you run an amortization table, and you see this has been paying down for almost 15 years, I got a little more excited. So then we'll take that debt, and we'll buy that property subject to that existing debt. But then the seller, there's equity. And this is where the challenge comes in, Mike, because this is what makes it so much different today than it did in the early mid 2000s. Back in 2007 to 2009, there was a tremendous amount of short sales that were happening in the marketplace, right? Yeah. That's not going to happen, in my opinion, moving forward. And the reason being is that all these properties have gone up in value, right? The rates have been low, so there's been some pay down, the balance. And so you'll see stuff that has, I'll go back to the example in a second. We'll see a lot of stuff that has a $300,000 value, market value. The borrower owes $200,000, okay? And they're in a default situation. Well, there's no way that they're going to short sale a house that they only owe $200,000 on if it's worth $300,000. And it's probably unlikely that the bank's going to ever foreclose on that property as a result, because the seller is smart enough to figure out a way out of that situation, whatever that might be. They could be selling it at a discount. It could be just selling and moving it, or selling it to somebody like us. And then we will buy a portion of that equity. We're basically paying for a portion of that equity that they have in it in lieu of the cheap debt. So on a situation like that, we might pay $270,000 for that property, for example, and we'll give the seller $70,000 in cash. We'll take the underlying debt at the 2.5%, 3% on $200,000, and then we'll go create something on the back end to create the cash flow. So the question becomes, these sellers have all this debt equity and they can't get that $100,000 out unless they sell. That's usually what happens. They can't go to a loan modification. They can't refinance because they're not in the position to do so. So that $70,000 has to come from someplace, right? Well, that $70,000 comes from private capital, right? That's what we will raise, and we'll put that note in there. We'll create a wrap mortgage, and then maybe we'll sell that piece of it out. Obviously, this is much easier to show and explain visually if we had some kind of a PowerPoint up, but I think conceptually you can understand the idea. Yeah. So we'll put somebody in a second lien position for that $70,000, for example. They'll be in a second, but they'll be behind a Wells Fargo that's at 3%. Well, for us, we're not even we're junior to even in that transaction. So the only way we get paid is if our private capital partners get paid. And it's a really good model for everybody because we will get paid. And that's the beauty about being in a bank, because that's really what we are at this time, is that we're a bank, right? And banks always get paid, Mike. They might not get paid today, they might not get paid tomorrow, but they will get paid because they have the one thing that a landlord doesn't have, and they have the asset as security against the note that they wrote to the borrower, period. So, you might have to go through a deed in lieu or cash for keys or something along those lines, or maybe a loan modification. All those things are very, very doable, and they happen all the time. But it also just protects the bank's investment they made into the deal. So that's sort of how all that works. And then I don't know if that answers your question or confused you more than I started out to do, but hopefully it said a little bit of insight.
And this is very familiar, obviously. It's what you explain is a classic subject too, and then you have to, in today's environment, like you said, you can't do a short sale. You have to buy out the equity. The question is, what do you pay for the equity? How steep of a discount? I mean, that's just spread creation, and then it's really a function of what deals you can work out with the seller. If the seller doesn't need the cash, they take a note. That's ideal for you. If not, you have to find an investor to give them a note. Basically to give you the money. And what do you typically pay on that second? I'm just curious as far as if you have a private investor.
Relative. Yeah, so it's relative to the asset, and it depends on where we are in the ratios, but it's somewhere between 7 and 10%. I mean, it's solid. It's a solid return. I mean, there's no question about it. It just really depends on where the asset, Dallas, Texas is not Cleveland, Ohio. You know what I'm saying? So if the asset's in Texas, we might be a little more bullish on it than some other places. The asset type, the asset class. Remember, we're going to underwrite the borrower. We're going to underwrite the borrower that goes into that property no differently than Wells Fargo, Chase, or Bank of America is going to do. We're going to follow Dodd-Frank and follow all those same guidelines that are set forth. We're going to write a qualified mortgage, and it's going to be written just like anything else. And we're going to stack the file just like they do. And we're going to use a third-party servicing company to manage all the cash in and cash out on the transaction.
So let me ask you that question. So that understood. How do you actually sell it to them? Because you have a first mortgage, which is your, like you call them Fargo. But forget about the Wells. the Fargo
right.
The Chase is the.
Yeah, right. I know. That shows you how old I am, right? So
that's okay. It's a wisdom how wise you are.
Exactly.
So
at least I know what Wells Fargo is.
That's right. So the first is a bank, then you got a second private. But when you transfer the title to them, do you do it through a trust? Is that how it happens? Is there basically a trust transfer? Because if the bank finds out the first, the Chase, whoever it is, they're going to say, wait a minute, the title transfer, we weren't paid. What's the scoop? They can get a little unhappy. And the investor to the property can't get high confidence that the first will be paid unless it's in a trust, right? I'm just curious, how do you structure that?
Well, you can surely structure it that way. Each state's a little bit different. Some are judicial and some are non-judicial, which could have a bearing on how you structure some of these things. But of all the transactions that I've done, we can count on probably one hand, Mike, how many have actually gone into the note being called. It just doesn't happen. If you create the paperwork correctly from the beginning, you do the insurance correctly. At the end of the day, banks just want to get paid. And if the banks are getting paid, go ahead.
Yeah, Nick. So what you're saying is if you do a transfer, actual transfer of title, essentially transfer to the new buyer, borrower, who you underwrite, Dodd-Frank compliant, all that stuff. They keep the first, they get the private second, and the first doesn't care. As long as they pay, it's not a big deal.
I'm not saying they don't care. I'm just saying that we separate the deed from the lien all the time, and it's not an issue. I mean, we don't go calling up the bank and saying, hey, we just did this. They get notified, and at the end of the day, they can choose to do whatever they choose to do. But we have things that we can do as well, because we bought ourselves time to be able to create that back end paper. We can surely go pay off the underlying debt to whoever it is and still continue to have our back end cash flow. The advantage of having the debt on the front side is it's cheap. And if we can write it for 6 months or 6 years, that's better than not having it in there at all, because all it does is allow us to create the back end opportunity. It buys us a little time.
No, it makes sense. I mean, I've seen this many times. Again, I've been to many of these events, and I've studied, and he's talked about this and similar ideas, and this stuff makes a ton of sense. So,
yeah, I think the big difference now that I see versus then is that there's fewer deals where you can go in and buy this stuff, zero interest from a seller or zero down. Sellers are there's enough equity in these properties that the seller are going to want some cash. And that becomes the real challenge, right? Because anybody can go create this model and do it if the seller only needs $1,000 walkaway money and they're not in the rears, 5 months, right? And the house doesn't need repairs. Where it becomes a challenge is when you need to leverage a lump sum of cash in this situation, call it $50,000. That has to be able to use to be able to buy the house, close the house, pay the seller their walkaway money, fix the house, resell the house, all those things. Those are all take time, and it takes a little bit of money to create the opportunity. But once that opportunity is created, it's a really, really valuable instrument that you have once it's been created.
Yeah, it makes a lot of sense. What can you finance to the new owner at what kind of rate? Just curious. If you basically did the work on the house, you took it off the hands, it was in some level of distress. Like the example you gave, $300,000 home, $200,000 mortgage. Maybe you negotiated a deal to buy it from $275,000. Is that enough spread for you? I'm just trying to understand.
Well, in that example, that's probably not be the right thing, but we might be at 325 on that property. But most of the time, like, if it's under a $250,000 price point, we're pretty aggressive on the price. We never overinflate values of the properties, because at the end of the day, we want to put the new borrower in a position to succeed, right? We don't want to put them in a negative equity position. Now, we're not free in what we do, and we do charge an interest rate that's in a guidance to what we're allowed to do, which is to keep it qualified and conforming. It's APOR plus 6.5%, which is the annual prime offer rate, which is a government index that says that we can write up to 6.5% above
over the prime,
whatever that index is. So if the index, let's say, is 3, then I can write up to 9.5%, and we'll write somewhere pretty close to that, somewhere in the 9s, because look, the borrower can always go refinance and pay it off without penalty at any point in time. That's completely up to them. But most of the time, really what they're comparing this to is the ability to have home ownership versus renting. And do you want to own it for $1,500 a month payment, or do you want to rent it for $1,500 a month payment? That's ideally where we like to get this model in. Now, it does vary depending on state and location, but at the end of the day, the question is to the borrower is that what's the interest rate on rent, right? I mean, it's infinite, because you don't get any credit back from rent. So that's where we are on it. But we've done this literally, the creative financing structure we did this model, I don't know the exact number, let's just call it over 500 times. It was probably closer to 700. And when we built this business initially back in early 2010, we built a creative financing model very similar to what we're talking about today. Now, how we acquired it was a little bit different, but we turned around and sold that business to a 100-year-old federally chartered bank that wanted this model to do it. So without getting into details on a short call like this, understand that when we built it, we built it not knowing that we would sell it, but we built it to sell in case we chose to do so. And as a result of doing that, it was actually bought by a bank because they could not do exactly what we're talking about doing. And so they built a whole nother entity and company to basically run this one-off model, if you would.
Well, this is pretty cool business. Yeah, I'm actually pretty familiar with what you do, because I know another gentleman who has done these conforming, but not not Fannie, not Freddie type of paper, and there are plenty of hardworking folks who can't get traditional product, and they wind up buying with this type of financing. So this actually makes a ton of sense. So let's pivot a little bit. We're actually running just a little short on time, but let's go back to the beginning of the conversation. So ask the question what opportunities it has created, and obviously it has slowed down the foreclosures and forbearances and all that stuff. What do you see things going forward? Do you see things changing? Are the foreclosures going to be allowed? You're going to see more distress. You're going to see, because we've effectively been operating in a super hot market for the reason that the government artificially prohibited distressed properties. Well, the property is still distressed. You can't foreclose. If you can't foreclose, it creates less distress. People are just, they're trying to make it through the pandemic. It makes sense. But with the current administration, where there's every intent to help the homeowners, do you see any changes going forward? Or I mean, in Texas, it's a world of its own. My land, your land, it's a different land, right? The whole country is such a different place, depending where you're at.
I think it's look. I said it earlier. Banks always get paid. They will get paid. So how they're going to get paid, I don't know the answer to that. I don't know if the government's just going to print a bunch of more money and give it to the homeowners so they can pay the debt. I don't know. I would hope not, because that doesn't do anybody any good. I think all we got to do is look at a country like Venezuela and see how that's working out for them. But my gut feeling, I think there's going to have to be some happy medium, but the banks are going to, the nice position that the banks are in is that they can just loan modify if they choose to and move those payments to the back end of the note if somebody can continue to make those payments. But we're going to see is that not everybody's going to be able to continue to make payments. So the bank is going to have to be allowed to take back their property so they can do something else with it. Otherwise, I mean, the whole financial market is based on
crashes. No, it doesn't crash. But yeah, it's a bizarre situation from the point of view that the banks are not allowed to foreclose, and then now we go in the realm of speculation what's going to happen for next. But it does look like as we come out of the pandemic, we're actually coming out pretty strong. As the economy is rolling, I think they'll probably allow some level of foreclosures. So, any final thoughts? Any parting thoughts? Any good book? How would people get a hold of you?
Yeah, so they can reach out to online at usanotepro.com. Most everything that we have there, all of our educational materials there. They can learn a little bit about more what we do. There's some ebooks on there if they want to learn more about note investing. We do a lot with buy, selling, and creating of notes as well. I see the opportunity. That's always going to be there as a staple on what's going on. But I really think that we have a unique opportunity to help a lot of people moving forward that are in the forbearance. They're going to come out of forbearance and help them out of a bad situation by preventing them from potentially going into a default status, and then also helping other people obtain home ownership when they've been told they can't. So those are sort of the two things that I see as the biggest add that we can provide for the people out there that we can help with. And that's it. Just go to USA Note Pro. You can reach me on there. You can reach out to all of our links to all of our social medias out there. We look at deals. I do all kinds of case studies and stuff all the time that can all be accessed on there as well. And And if there's anybody has any questions and wants to learn more on how to buy, sell, or create notes, send us an email and we'll be happy to jump on a call and see if we can help them out.
Thank you for sharing, Nick. Much appreciated. And that's usanotepro.com to reach out to Nick to chat about notes. Thank you very much.
All right, buddy. Thanks again.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike Zlotnick. Keep listening and keep investing Big Mike style. See you on the next episode.